The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts. Do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
It is Chuck and Mike and Tucker with you. And we got a piece here from it's from the Boston Globe. Is it pronounced Globe? No, it's not. Boston Globe. And the headline is "Bad News Keeps Coming. The stock market is still breaking records." So, this is a very party pooper extraordinaire piece. And I think that what I have found to be useful over the last couple of months is being able to hold two distinct ideas in my head at the same time that may have some contradictory aspects to them. Number one, inflation is absolutely going up. The cost of living is going up. Paychecks are not going up fast enough. And so the average American is not feeling very good about their finances right now.
Yeah. And beyond just surveys that ask people how they're feeling, we have some other evidence to support this fact. Actual numbers on debt delinquencies and things like that to back up the idea that, yeah, they're telling us they're not feeling great about it, and there's some evidence of that.
On top of that, if you want to toss some more bad news on the pile, Strait of Hormuz, still closed.
Indeed.
Iran did let reportedly about 30 Chinese-affiliated vessels out overnight, which is fascinating, and we'll get to that in just a little bit. But the Strait of Hormuz is still closed, which is not good for the intermediate-term energy security of the human race.
Sure.
So there's some negative stuff out there. But, and I did just say but, ladies and gentlemen, what has been driving the stock market for the last 3 years is not you and me spending money going to Walmart or Target or Cracker Barrel or Five Guys or any of that stuff.
Nor is it the profits of oil giants and their refinery capacity.
What has been driving this market since the start of 2023 is artificial intelligence and the CapEx spending cycle. And so the two ideas that you need to hold in your head are things are pretty clearly getting worse for the average American's financial situation due to stress in the economy right now.
Mm-hmm.
But it also doesn't matter because that's not what was driving the stock market for the last 3 years anyways.
Yeah, it's tough for me to say that bad news keeps coming when...
What about the good news that keeps coming?
Right.
And look, I've been a little divergent on this in that I'm probably one of the more negative people you will meet when it comes to the state of world energy markets right now. I think there is a real bleep storm coming this summer that the world is not adequately prepared for. But some of you, have been listening for a long time, a month or so. Some of you might remember that in early to mid-April, I said, look, if you want the positive view on this market, and this was when the S&P 500 was sitting at about 7,000, maybe 7,100. I said, here's the positive view. Earnings expectations have continued to grow, and we've grown into some of the valuation things that have been problematic. If you thought that stocks were fairly valued last year with the S&P 500 trading at 22 times forward earnings, then today, if you think that you can get to stocks being valued that same way, the S&P has a clear path to 7,500. And lo and behold, ladies and gentlemen, we're sitting here right now at 74.71. So I can hold these two divergent views in my head, which are, hey, there's an energy problem that is screaming towards the human population over the next 2 to 3 months. And that may end up disrupting things, by the way. Like, I won't say that it won't. It may end up disrupting the earnings story. But the other thing I can hold in my head at the same time is, despite that energy problem, the earnings story largely remains intact because it's based on things that are not driven by the cost of gasoline and the price of fertilizer. Like, again, like, these are things that don't matter for building a data center, except at like the very peripheral margin when it comes to how much does it cost to drive the stuff to the data center and how much does it cost to feed the people building it.
Right.
So
it comes back to something that we've repeated on the show, but it might have been a while. The economy is not the stock market, and the stock market is not the economy.
No.
And we tend to confuse these things. We like to use phrases like, well, markets hate uncertainty, and there's a lot of that going on right now. There's a lot of global change going on right now. But I think contextualizing here for a minute, just how rare it is for the U.S. and global economy to go through contraction is pretty important. And I think if there's one thing that's been proven over the last 70 years, it's that the global economy is pretty resilient to shocks. And we're getting, year after year now, pretty big shocks to the system. And clearly the U.S., the world economy has not sunk into recession, and the U.S. economy certainly hasn't. And so, again, diverging these thoughts for a moment here, the economy is not the stock market and will not drive it forward.
So, again, I'm not saying this because I'm very much not, hey, you should just feel better about how you're doing. No, I'm not saying that. I'm saying that the factors that are hurting you in your financial situation right now are not ones that are hurting the stock market, which is driven by earnings, growth, and expectations. Those have not been impacted to this point negatively. Yeah. They just haven't. And it's not to say that this is an across-the-board phenomenon. When we look at data from FactSet Earnings Insight, they're an aggregator of earnings data. And when we take a look at calendar year 2026, as an example, you take a look at some of the areas in the economy and you say, okay, what are we seeing here? Just in terms of let's look at sales, because I think this is a good place that is informative on this side. If we look at some of the sectors of the economy that you would expect to be impacted, real estate, just as an example, their revenue growth, real estate stocks, expected to increase at 6.6% this year. Before the start of the year, before the start of the quarter, it was 7.2. So, okay, yeah, it makes sense that, revenue in a place like real estate isn't really, moving. Consumer discretionary stocks, which, again, the problem with consumer discretionary, it's kind of a broad category that includes anything from Amazon to Tesla to Home Depot to Booking.com. Consumer discretionary revenue projected to rise 7.7% this year compared to 7.2%. So you'll say, okay, that's an increase. But a lot of that's being driven by airfares going up and other stuff is, coming down to offset that. The real growth that's happening is in tech, it's in energy, and, to a certain extent, materials. That's where the growth in revenue and earnings projections is coming from right now. Communication services to a certain extent, but again, kind of a messed up category that somehow includes both Meta and Verizon within it, so I find it to be a kind of useless, broad category. But, again, you can conceptualize this where you say, yeah, households are going to have less money to spend because of higher prices, but household spending is not the marginal driver of economic activity right now, and that's why these two things can coexist for now. You do get to a certain point where, yes, if, gas prices go so high and airfares do and food prices do, yeah, then you can start to see, enough drag on the consumer spending side that maybe it offsets some of the other growth that you're seeing. But you ain't there yet.
Right.
It's not where we are right now. So 2 thoughts that you got to hold together. 1, yep, things have gotten harder for American households over the last couple months. 2, American households were not driving this market for the last 3 years. Why would you expect them to now? Let's take a quick break. When we come back, let us talk China next.
The Financial Exchange streams every day live on YouTube. Subscribe to our page and follow the markets all morning long. Only here on the Financial Exchange Radio Network. Find daily interviews and full shows of the Financial Exchange on our YouTube page. Like us on YouTube and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
The Financial Exchange is incredibly proud to be a partner of the Disabled American Veterans Department of Massachusetts. Nearly 400 runners have already registered for this year's DAV 5K. The event sold out in record time last year, so head to dav5k.boston for all the information about how you can participate this November or make a donation to support our great American heroes. Your gifts help fund free rides to medical appointments for veterans and the nation's first DAV-led housing initiative, providing homes for single veterans and veteran families. Go to dav5k.boston and make your donation today. That's dav5k.boston.
President Trump has been in China for a little bit over 24 hours now, and earlier this morning concluded a one-on-one visit with President Xi that lasted for about 2 hours and 15 minutes. Readouts from both sides indicated basically that, the two countries want to try to, move forward with, an attitude of stability. I'll quote here. Handled well, relations between the two countries can maintain overall stability. If handled poorly, the two countries will collide or even clash, putting the entire U.S.-China relationship in an extremely dangerous situation. So, again, I think my expectations for this summit relative to some of the other ones the two have had were relatively low. I didn't expect anything major to come out of it. And to this point, it doesn't really seem like anything is. The two sides did agree that Iran should not control the Strait of Hormuz, but there's probably differences in terms of what that means to each side. Mm-hmm. And with that in mind, I think it's very interesting to talk about what Iran announced this morning, basically shortly after the Xi-Trump meeting concluded, which is that they had let 30 Chinese vessels pass through the Strait of Hormuz overnight.
Have you seen confirmed reporting that I've seen 4 that actually successfully did so.
We haven't seen any confirmed reporting. And so with Iran reporting this, you always, have to take it with a grain of salt because you don't know what's actually true. And also remember that currently within the Persian Gulf, there are about 1,000 ships that still remain trapped there right now. These are not all large crude carriers and things like that. It's anything from small resupply vessels, smaller cargo ships and things like that. So don't think there's just 1,000, there's not a billion barrels of crude sitting there. There is about, 160 million from what, I can gather.
But the status quo here was that Iran has said that they have described a safe permit-based shipping corridor through the Strait of Hormuz at the same time that the United States has said we're going to blockade any of those ships that try and navigate it.
Specifically ones that are Iranian, heading to Iran. So Iran says, hey, we're going to let 30 ships out while President Trump and Xi are meeting. It then puts, remember, China does not have, a military force in the region, active on a naval mission. So the question that you then have to the U.S. military is, okay, do we stop these ships, in which case word probably quickly gets to the Chinese delegation, and Xi says, why'd you stop the ships coming to China? Or you let them through and now your blockade
doesn't exist.
Isn't really a blockade. So this, again, I don't know that you're going to see any sustained move in this direction. I think this was very clearly to send a message during this meeting. I would be kind of surprised if you saw it continue over the next couple of days here.
Is it a message sent by the Chinese or the Iranians, or does it not matter? Because to me, it's a message sent by the Chinese.
I think... Look, here's the thing. The Iranian Foreign Minister, Aragachi, was in China a couple days ago before this. I suspect there was some coordination here in terms of it's a message from both. The message from Iran is, hey, you think you control the strait? No, we control the strait. Mm-hmm. The message from China is, hey, the leverage that you had over us was, you could maybe, let some of our ships go through. Well, we just did that and took that leverage away. So I don't think this solves anything in the Hormuz situation. It still remains largely closed. It certainly is great that you're getting some ships out, but again, we still need an accurate count from a third-party source, which we don't have.
Well, but to be clear, I don't think anyone here domestically would consider a Strait of Hormuz that is only open to Chinese-flagged vessels as anything resembling good news. I certainly wouldn't.
There are a few different things that we need to unpack there. The first is, as long as you can get cargoes out through the Strait of Hormuz, it doesn't really matter where they go because commodity markets are global.
Agreed.
Like this will if you can get things out and they're going to China, it's not ideal, but it'll balance at the margin.
Yeah. So from an economic standpoint, I agree that if ships are just flowing to China, then you will have oil prices lower. That's not what I'm focused on, though.
The piece that, quite honestly, the rest of the region is not going to accept is Iran having veto power over what goes in and out, because then Iran is setting oil prices, not OPEC. Like that's very clearly what it becomes. And so the thing that needs to get sorted out is, hey, what is going to be allowed to to go in and out of Hormuz, and who has the authority to determine that?
And is Iran collecting revenue? A lot of challenges to U.S. military power in the region if this is what happens.
And economic, quite honestly.
Yeah.
Because in order for Iran to be able to collect any revenue through, through means that actually allow reputable shipping companies, and not just the sketchy ones that, are happy to skirt sanctions and things like that.
It's got to be dollars.
It has to be connected to the SWIFT system, basically.
Yep.
Your Greek tanker companies that are, already, on sanction lists and things like that, fine, they're going to pay in, Bitcoin and whatever they can. They don't care. They're not going to pick up other legitimate cargo. The ones that do care, the Maersks of the world and things like that, listen, they need to not show up on the Treasury sanctions list in order to be able to operate, and so they can't pay those tolls anyways. So I think that we go into the weekend most likely still with more questions as to what is actually going to happen with the Strait. And this is your daily reminder that every day that the Strait remains closed, another 12 million barrels of oil remains shut in on a daily basis.
Yeah. The timing of those ships moving, though, is
not a coincidence.
Not coincidental. Yeah,
no.
It is very obviously a power move orchestrated by who is a fair question, but yeah, to see
the thing's been going
ships
on,
going to China while the president is in China on a state visit is very much a challenge to the president's power.
The thing's been going on for 75 days now.
Yeah.
You think that just randomly,
coincidentally,
they're like, hey, you know what? Let's let some Chinese ships through today.
Mm.
It's a great day to go to Beijing. Not a coincidence is where I tend to land. Let's see. We got some inflation data over the last couple days. It was warm to quite roasty.
Hot.
And so I want to take a quick break, but when we come back, the Boston Fed's head, Susan Collins, talking a little bit about, hey, what does this mean? Collins, not a voting member this year, so doesn't have any influence on policy for the next 8 months. But what could it mean for how the Fed approaches things going forward? We'll discuss after this.
Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Markets in positive territory, being propelled by strong earnings from Cisco. Wall Street's also following developments from the summit between President Trump and Chinese President Xi Jinping. Right now, the Dow's up about 0.5% or 226 points. S&P 500 also up about 0.5% or 35 points. NASDAQ also up 0.5%. Russell 2000 up about 1/3 of a percent. 10-year Treasury yield down 2 basis points at 4.455%. And oil up about 1/3 of a percent, trading right around $101 a barrel. Cisco rallying 14% after the tech firm announced it will cut fewer than 4,000 jobs this quarter, or about 5% of its workforce, so it can allocate more resources into high-growth areas like AI infrastructure. Meanwhile, Versant Media Group saw its revenue and profit fall in the second quarter since being spun off from Comcast, but they were better than analysts expected. The company also reported revenue growth across its content licensing and digital platforms. That stock is jumping over 8%. Elsewhere, Biogen shares down by 4%, despite the biopharmaceutical company announcing its experimental Alzheimer's drug will advance into a phase 3 trial. Outdoor products company Yeti impressed with its quarterly results, sending shares up by 5%. Ticket seller StubHub also beat expectations, sending shares surging by 19%. And semiconductor equipment maker Applied Materials will report earnings after the closing bell. I'm Tucker Silva, and that is Wall Street Watch.
Mike, we got a piece here in the Wall Street Journal. It's titled Boston Fed's Collins flags rate hike scenario as inflation risks tilt higher. And basically, this is exactly what it sounds like. The Boston Fed president, Susan Collins, said that, hey, depending on how inflation moves, we might need to have higher rates if there is, in fact, higher and more persistent inflation. This is not really a surprise to the market, which, after the last couple days, is now pricing in the first move to be a rate hike rather than a rate cut. Now, when we take a look at the CME Fed Funds futures market, that rate hike is being priced in October of 2027. So 16 months from now, which means it's not worth the paper it's printed on.
Sure.
Because things can change a ton over that time span.
I will say that when you look at the December meeting, though, the most likely scenario is that rates are exactly where they are now. But there is a 30, basically a 1 in 3 chance being priced in that rates could be higher than where they are right now. And basically no chance of a cut.
Which is, from a month ago, it's basically a complete pivot. A month ago, there was about a 33% chance of one or more cuts being priced in, and now you've got a 36% chance of one or more hikes being priced in. So I do think that the market is waking up to the fact that, hey, it's kind of hard to cut interest rates when you're at 3.5 on the Fed funds rate and inflation's now heading for 4. It's probably not going to pass the sniff test.
May I just say that for those that want to use this moment to compare to the dot-com bubble in the late 90s and early 2000s, there sure are a lot of, don't get me wrong, there are a lot of differences in the types of companies that are going public, the revenue and profit that's being generated from the new technology, but boy, are there some macro similarities. In June of 1999, the Federal Reserve had just come off, the last year on a cycle of 3 rate cuts.
Yeah, the Matrix had just come out.
And in June of 1999, they started saying, hey, things are getting a little bit frenzy-like. Greenspan was describing the irrational exuberance. I think that might have come a little bit later. But the Fed then went on a rate hiking cycle in the summer of 1999 right through the spring of 2000, bringing interest rates from 5 to 6.5%.
Yep.
After just cutting rates the previous year, and generally moving from a higher rate environment back in the early to mid 90s through the late 90s. Again, I know there's a lot of differences out there, but what are we really talking about in markets right now? Wow, look at these big IPOs that we're going to see today. We'll talk about one that just went public yesterday.
Did you? What about the one from today? You mean today?
Was it today that
Cerebras?
Yes. So today.
Did you see the numbers from this morning?
No,
I did.
But
they're wild.
Yeah, it just. Again, I was talking to somebody about this yesterday, and their perspective was it's nothing like that. And I don't think that quite does it justice. It's different. It's always different this time. But there are a lot of echoes of similarities.
Look, I've said this before, and it's not my own quote, so I wish I had been creative enough to come up with it, but you've got this turducken of economic risk right now. And remember, economic risk does not mean that, like, the bad things end up materializing, but you do have, eventually, guys, eventually this semiconductor bubble's going to pop. It might not be for, 1 to 3 years. It might be a week or two from now. It might have already popped. We don't know, but I can tell you that semiconductor stocks don't go up 80% a month for the rest of your life. That's not going to happen. So again, you've got this tech bubble that is inflating, that eventually is going to end badly. When it ends badly, I don't know, but eventually something will come of it. To this point, it's cranking, it's humming, and understand that can go for a while still. I'm not saying it's over. I'm just saying there's a problem in tech. You got this private credit problem that is very reminiscent of the housing crisis, but we don't really know the scale. It's sure. Smaller than the housing crisis, but it still is kind of gnarly. You've got an energy shock that's reminiscent of the 1970s that's going on right now. So you've got 1999, 1973, and 2006 all jumbled up here, and it's kind of like, well, maybe you can escape 2 out of the 3 of these, but one of them's going to hit. Something is going to end badly here at some point. And what Collins is raising is, look, the private credit stuff, for all the concern we've had about it, hasn't shown up in the economic data in any way, shape, or form. Right. At some point it might, but to this point, it just hasn't. It's not a thing. The tech bubble stuff, by and large, every time we've had questions about, hey, can CapEx continue? They've been answered affirmatively. Right. And so the CapEx has continued.
By the way, using the counter argument here, we have a incoming Fed chair that has been very public about wanting lower interest rates. I think that's wildly inappropriate right now. But you want an argument for the tech rally continuing? What if rates come down later this year? That'd be. Again, I think there's no argument for it to happen. I think it'd be the wrong policy maneuver. Plenty of Fed chairs have made stupid policy maneuvers.
And so Collins raises the point of, look, the next move, depending on how things resolve in the Middle East, if this is more persistent than markets are pricing, remember, rate hiking cycles and rate cutting cycles, the word cycle's in there for a reason. The Fed never goes one and done. They just, it's not how they behave, at least at this point. If you look at, way in the past, sure. It's typically, okay, we're going to do this for a meeting and another, and we'll continue until we think it's appropriate. In the last few years, it's been, anywhere from, 4 to 5 meeting cycles, 3 to 5 meeting cycles, and you're good. The risk to markets is not that the Fed funds rate goes from 3.5 to 3.75. The risk is that the Fed funds rate goes from 3.5 to 5.
Right.
It goes from 3.5 to 5.5.
Like happened in 1999.
Because, I've said this before, everyone gets all excited, ooh, is the Fed going to cut 0.25%? Who cares? It doesn't matter. 0.25% rate cut in and of itself is like me, swatting a fly on my nose in the summer. It doesn't matter to the broader world. 0.25% cut at 6 consecutive meetings or 0.25% hike at 6 consecutive meetings, that is a meaningful shift worthy of attention. But everyone's like, ooh, is the Fed going to cut this meeting?
Irrelevant.
Who cares? Pay attention to the cycle, not to the meeting. Let's take a quick break here. When we return, let's talk about, speaking of turning it back to 1999, I got to tell you, when the hottest 2 stocks for the last week are Intel and now Cisco, listen, if you've been in a coma for the last 27 years and just woke up,
nothing's changed.
This will make you feel right at home. Quick break. We're talking Cisco when we come back.
Remember, you can watch the show live every day on our YouTube page.
Cisco reported earnings after the bell yesterday, and the stock, well, it's up 14% right now. It was up 22% pre-market, but it has pulled back. But Cisco stock is absolutely cranking at the moment, and now has actually surpassed its year 2000 peak just 26 years later. It actually surpassed it last week. The big thing, though, to remember on this is Cisco, like many companies, has been going through share buybacks for, much of the last 20 years. And so even though it reached or has surpassed a per share peak.
Jesus. Don't mind me, just dropping stuff.
Something you want to tell us, Tucker? Was it big news or something?
Yeah, he always throws his microphone.
I'm just
whenever
a
there's big news.
clumsy fella. Don't worry about me.
Even though Cisco
Drinks out of a sippy cup.
Even though Cisco has surpassed its per share peak, it still has not yet gotten to its market cap peak that it hit back in spring of 2000.
It's just amazing. I mean, Cisco is being described once again as the picks and shovels of the AI industry, or the plumbing of the AI industry, which is quite literally the exact terms that were being used in the 90s to describe Cisco when it came to the internet.
Now, this is
not saying it's wrong, but it's the same company going through the same exact description of their business model 26 years later.
This is a stock that spent the period of 2001 through 2017 without any share price appreciation, and then spent mid-2019 through mid-24 with no share price appreciation. So I think, again, there's been some false starts here, and I think the real question is, look, is this actually a rising tide lifting all boats, or is this Cisco being late to the game and just, kind of a flash in the pan that's not going to mean much?
Well, I bet they're going to sell a whole bunch of stuff. The question is, will they sell a whole bunch of stuff for a long period of time?
That's what I mean.
Yeah, I mean, flash in the pan is the right analogy. I don't know, but I can tell you what happened in 1999.
So, again, we'll see how things go here, and we'll take it one day at a time with them.
Long-term care costs can reach thousands of dollars per month and can put a serious strain on your savings. The experts at Cushing & Dolan often see families caught off guard by that reality. Without the right plan in place, those costs can quickly eat through a lifetime of your hard work. But here's the shocker. Many estate plans don't protect your assets from those expenses. The right strategy may involve specific types of trust designed to help protect your assets, but timing matters. Cushing & Dolan has a brand new guide called Detour Ahead: Estate Planning Potholes to Avoid. It breaks down some of the most common and costly mistakes people make and explains how to help protect your assets, your family, and your future. Call 866-848-5699 right now to get your free copy. Once again, the number is 866-848-5699, or you can request the guide from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Piece of the Boston Globe: Mansfield becomes first town in Massachusetts to pass near total ban on data centers. Basically, what the article in the town bylaws states now is that only Tier 1 data centers, facilities using up to 2 megawatts of electricity, which is not very much, would be allowed, and only in certain parts of the town. Tier 2 and 3 facilities, which are basically between 2 and 10 megawatts and more than 10 megawatts, those would not be allowed anywhere in the town. So there's a couple things that I believe to be true here. The first is I don't think we're doing a great job of building out the support infrastructure for data centers in the form of electrical and water resources that are needed.
Okay.
The second piece is that the solution to this is not saying, well, we can't do that, so we're just not going to build data centers. Like that. This is kind of like if back in like the 1920s we had been like, hey, all these cars are taking up the roads for our horses, so we're not going to allow cars because we haven't done a good enough job, widening the road so the horses can be on them too. Like, it's just not... You know how Wayne Gretzky used to skate where the puck is going?
Sure.
This is skating...
Now you give me an analogy I can think through.
This is skating towards the vending machine. It's doing what feels comfortable instead of what's going to push things forward. And look, I'm on record as saying I don't want like a data center in my basement, but I would take a nuclear power plant there. But,
whereas I'll take the data center in my basement.
So, but like we have a symbiotic relationship in that way. So ultimately, look, the world is going to need more data centers in the future. There is going to be more artificial intelligence usage in the future. These are incontrovertible facts. I don't think I can have much uncertainty around these. You can either choose to build that out in a responsible and thoughtful manner, or you can do the opposite. And a ban of large data center construction is just as destructive to participating in that future as allowing too many data centers to be built willy-nilly with no control over them at all.
Did you see the planned Stratos project that's been getting attention in Utah?
No, what's that?
It's a 9 gigawatt, 40,000 acre AI data center plan.
40,000 acre?
That's 2 times Manhattan. Just some comparison there I thought would be nice. 2,000 Walmart stores combined is 40,000 acres.
This is why when people talk about orbital data centers, I'm like, guys, we can launch 20,000 pounds into orbit at a time now.
Doesn't seem like it's going to work that well.
How are you going to build Manhattan 20,000 pounds at a time?
2 times Manhattan, to be clear.
Let's start with 1 first.
Yeah, it does seem like this is one of those moments where we need a little bit more coordination about how this is all going to work, because otherwise you're going to have a scattershot of different policies and plans, location to location, and that's, I don't know, doesn't seem like a great recipe for success when it comes to AI build-out.
Beyond this, look, there's a lot of towns in Massachusetts that are desperate for tax revenue.
Yeah.
What if Amazon or Microsoft said, hey, we'll give you 4x the regular property tax rate if you let us build this here?
So maybe that's the way maybe we just ban them until they come together and say something like that.
Maybe. Let's take a quick break. Hour 2's coming up in a bit.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts. Do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Chuck, Mike, and Tucker here, and as we kick things off, we got all major U.S. indices in rally mode today. It's been basically the case for the last month and a half now, but the Dow Jones Industrial Average back above 50,000, up 401 points, about 0.75%. S&P 500 up 54 points, 0.75% as well. The NASDAQ 100 and NASDAQ Composite both up about 0.75%. Even that cute little Russell 2000 here. There you go, little boy. Here, yeah, there you go, good boy. Have a little treat. That is, that's up about 0.6%. So, whether you're talking about your Great Danes or your little Yorkies, all the dogs are getting fed today.
There you go.
And especially when we talk about dogs getting fed, Cerebras Systems, a tech company that is going to be that's IPOing as we speak right now. They are raising about $5.5 billion in an IPO today. And
that was the plan. Turns out it's going to be a little more. They
build computer chips for AI inference workloads. And the IPO was originally going to go off at about $110 to $115 a share. By the time they got through the underwriting process, they upped it to $185, and it still is not trading, but I'm seeing, again, just from reports from people who follow this stuff, that the initial trading may actually open somewhere north of $400 a share.
Oh, my God.
Which, I got to tell you, this is the stuff that you saw back in 1999. Now, it doesn't mean that this can't continue. I'm not saying that it won't. But what I am saying is tech hardware IPOs that double in their first day, not really something we've seen for the last 25 years.
Yeah. So, again, I'm not justifying the price that this is going off at. I will say that Cerebras has revenue. They did have positive net income for the first time ever this year. It's this
misconception that like all of the IPOs in the tech bubble had like no revenue and just like a web page. Like,
agreed.
Again, we covered Cisco is the ultimate face of the tech bubble.
Yeah.
It became one of the most valuable companies on the planet and then lost 80% and didn't get back there for 26 years.
Yeah. Again, I just don't want to call this one of the .com fanatic companies that, hadn't printed any revenue and went public based on users.
Why are we all so offensive? Why are we so worried about offending people by saying that this is like the tech bubble?
Yes,
it is. It's like the freaking tech bubble. It will burst at some point. It's probably not today or tomorrow or next week or even next month, but it's just like the tech bubble. I'm sorry. Successful companies came out of that.
Yeah.
A lot died, but successful ones still. Let's talk about Microsoft. One of the most successful companies today. Microsoft, you go back and take a look at how it was valued in 2000. It was $57 a share. It went down to 25 and basically sat there for 15 years before finally recovering. Like, no one looks at Microsoft and is like, well, they didn't have, no revenue, and so that means that good companies can get caught up in bubblicious valuations too, and I am telling you, this is just like the tech bubble.
Yeah, so a company that is pricing their IPO, again, like you said, a couple weeks ago was supposed to be $110 a share. IPO's at $185, and again, trading's not yet occurring. It's halted at the moment, but if that goes off at $400 per share on a company with $500 million in revenue, wow.
I mean, Mike, the Philadelphia Semiconductor Index since March, hold on, let me get this date right. Since March 30th, month and a half, is up 73%. You can't do that every month.
Yeah.
And I'm not saying that this is going to blow up tomorrow because, as I've been saying for the last month, it's really clear that the demand for inference in AI dramatically exceeds supply right now.
Which is what Cerebras does.
But I can also tell you that we have never been through a tech hardware capex cycle that didn't end with tech hardware investors in tears.
Washed.
Like, it's how it ends every time. And again, that the runway might be a year, it might be 3 years, it might be 5, it might be 10. I don't know.
What do you mean by every time? Right? I mean, obviously the tech bubble, but there are other ones that are smaller too, right? Remember 3D printing?
No,
didn't blow up the system.
I'm talking about semiconductors specifically.
Okay.
Like here's the deal with semiconductors. Do you remember back in 2022 when the U.S. stock market fell 20%?
I recall, yeah. I think it was more like 25, but yeah.
The Philly Semiconductor Index was off 50%.
Okay.
Do you remember from July of 2024 through April of 25, when stocks fell, again, about like 25%, the Philly Semiconductor Index was off 50 again.
Right.
You go through these like even mini boom bust cycles, and it's crazy. Like the volatility in this area is just huge. And you can look back again through pretty much the whole thing. Back during the actual tech bubble, you saw like an 85% drawdown here. Like semiconductor stocks, the reason why typically, like if you look at them from, again, 2000 through 2020, we're talking about a 20-year period where the sector was basically not accretive. And the reason why is that the margins just get whittled away. It becomes commoditized. Why do we think that AI is any different? Do we think that like AI semiconductors are not going to go through that?
Of course not, Chuck.
There are, some differences in terms of like the architectures are different, and sometimes you can end up being locked into a certain ecosystem, and that helps, someone maintain margin and things like that. But I am not going to believe that this is going to be like, hey, guess what? We've escaped, and now semiconductors are going to be, more valuable than everything else combined.
Yeah, I don't believe that either.
I just can't get there. So I firmly, again, we talked earlier in our show, you got to be able to hold two thoughts in your head simultaneously, one of which is this going to end badly. The other being maybe not yet, because the demand growth is crazy right now. Now, the other piece that can affect demand growth that I think is interesting right now, if you talk to anyone who's at a big tech company, they'll tell you that a lot of these big tech companies have leaderboards for who uses the most computing capacity in a single day. And like tech companies are trying to grade people on that. Remember, compute capacity costs money. At some point, tech companies and other companies are going to move from, hey, we want you using the most compute to we want you producing the most per unit of compute.
They just don't know how to measure that yet.
And when that happens, that is the potential inflection point, in my opinion. Because right now, like, it's literally just a race to be like, hey, who can use the most compute possible? And as I've said before, if you dig a hole and then fill it in, you're doing something. You're doing a lot of work.
Yeah, you're generating economic
but it's not
activity.
Productive work.
Yeah.
At some point, we're going to move from digging virtual holes and filling them in to actually needing to do productive work. And that's where, the potential inflection point is. We're not there yet. Let's take a quick break. When we come back, we've got trivia, and then we're talking Kevin Warsh being confirmed as the new Fed chair right after this.
Market insight, retirement strategies, real talk about Wall Street and economic trends. All live every day on our YouTube channel. Go to youtube.com/The Financial Exchange Show. This is The Financial Exchange. Markets move fast. Follow The Financial Exchange live on X so you never miss a story. This is The Financial Exchange Radio Network.
Time for trivia here on the Financial Exchange. On this day in 1787, delegates gathered in Philadelphia to draw up the Constitution of the United States. So our trivia question today, how many amendments are in the Constitution? Once again, how many amendments are in the Constitution? Be the fourth person to text us at 617-362-1385 with the correct answer, and you'll win a Financial Exchange Show t-shirt. Once again, the fourth correct response to text us to the number 617-362-1385 with the correct answer, along with the keyword trivia, will win that t-shirt. See complete contest rules at financialexchangeshow.com.
Would you ever try to pass an amendment to the Constitution?
Definitely.
Yeah, I don't know what I would do, but I feel like it'd be kind of fun, In any case, Kevin Warsh, not in the Constitution, but now back in the Federal Reserve, confirmed yesterday by a 54-45 Senate vote. I don't know who didn't vote because there are 100 senators, and one would think that this would be a vote that you show up for, but I don't know. Let's see. Oh, here we go. Senator Kirsten Gillibrand didn't vote.
Busy.
Like, why? Why? Like,
Had to pick the kids up.
You're not going to vote on the Fed chair?
Just have no opinion on that one.
You couldn't have any other day to do whatever it is you were doing. I'm sorry. I know that this is like kind of a minutia, but it just seems like kind of a big deal to not miss this vote.
She's got vacation plans.
In any case,
Members of Congress are very busy during the summer.
It's May 13th yesterday. Like we're not even to Memorial
Summer
Day.
in DC, okay?
Packing.
The weather's been crappy all week. Like, what are we doing here? In any case, Kevin Warsh is now going to be the 17th chair of the Federal Reserve, and so he will be taking over from Jerome Powell in about a week. And his first meeting is going to be the meeting in 34 days, concluding on June 17th. And so we're going to get, I would assume, our first Kevin Warsh press conference. And I think it's going to be interesting to see how he actually attempts to steer the Fed now that he is actually in the chair. I will say it is hard for me to think of a worse environment to enter than the one we're in right now in recent history. I guess maybe
for any Fed chair or for Kevin Warsh specifically?
For any, I mean, Mike, here's the deal. You've got an inflation picture that is incredibly uncertain. You have a jobs picture that, because of, combination of artificial intelligence and labor supply, is incredibly uncertain. And you've got on the fiscal side, a government running 6% annual deficits, and you've got to figure out how to make this all work without blowing it up.
I'll throw in there another significant piece of this, which is you've got the most significant threat to Fed independence that's probably happened since the Nixon era.
Probably, again, I want to.
I know you poo-poo that, but I
do
don't.
just because I want to see how Warsh actually handles things. And the reason I bring this up is like Scott Bessent was talking a whole bunch of stuff about, when I come in as Treasury, I'm going to do this. And basically, he kept doing the exact same stuff Janet Yellen was doing. Because he got in and he was like, if I push that button, things are going to go badly.
Yeah, I'm not so much talking about what Kevin Warsh has said, rather what President Trump has said. And the president has wanted his thumb on the scales of the Federal Reserve, and that makes it challenging even were it somebody who hasn't run on a candidacy of appeasing the president.
So again, I'm interested to see. I really try not to prejudge people in roles, because it's like, if we're going to do that, then we might as well just cancel the show. We might as well just not do the show if we're going to say, well, they're going to do a bad job. Like, I got no idea. We're going to see how he's going to do, and it's a challenging environment for him to enter into, and I think there are a lot of cross currents he's going to have to navigate successfully in order to steer the ship over the next 4 years of this term here. So again, his first meeting is going to be in 34 days. We may get some changes in communication policy. Like before Powell, we did not have a press conference every meeting. Maybe Warsh goes back to that. Maybe there's some changes in terms of the style of the readouts that we get and things like that. Maybe the meeting minutes, change in terms of their format. He might do away with the dot plot. The dot plot is not like a required thing for the Fed to do. And so we'll have to just see what we get, because I don't know, quite honestly. And I try to keep an open mind. And if he ends up sucking at his job, well, then we'll be able to, Mark Fandetti will be here to call him a failure. If he doesn't, then we can call him a tremendous success. But I'm going to see how the guy does, and I'm going to give him the full term as well, because, again, there's times in Powell's most recent term, in 2022, he and his entire group kind of sucked.
Yeah, they kind of screwed the pooch. I guess
the last 3 years, they've been really good.
That's part of what I want to address, because Warsh is coming in and publicly stating that he wants to shake up the Fed. And I think what he means by that is he wants to shake up the way that the Federal Reserve Board thinks about their role and where we are today and just how these things all relate to each other. And I think he might get some of that rope to rethink all of that, given the failures of the Fed over the course of the last 6 years. I don't know that his conclusions will be right, but there have been some screw-ups, especially in the late stages of COVID leading into 2022 at the Federal Reserve. And I think part of that is the thinking of how they dealt with inflation at that point in time.
So, again, I'm very much not going to, I don't know what he's going to do. Like, he might have, a great start to his tenure and then a horrible finish. He might have a horrible start and a great finish. He might be good or bad for the whole thing. Like, I don't know. But I think it's clearly, look, we haven't had a new Fed chair in 8 years now. It's been a while. If you go back and look at, the most recent ones that we've had, I got to be honest, in looking at Powell, again, these are all personal views on this.
Sure.
Alan Greenspan was handed a gift of an economy, and under his Fed, the kind of changes that happened, you can have a direct line to the financial crisis because of the actions of the Greenspan Fed, specifically kind of from 99 through 2004. All kinds of changes to like bank, collateral requirements and things like that. Things that we don't think of when we think of the Fed, but all kinds of problems there. Ben Bernanke, I think you can point to and say, manage the Fed through the greatest financial crisis that we've seen in our lifetimes. But in doing so, ended up taking a lot of, power basically from Congress, and I'm not sure you want that all concentrated in the Fed. Janet Yellen didn't really have to do a ton. It was, 2014 through 2018.
Yeah.
There wasn't much to be done there.
All she had to do was not buy in that it was going to be inflationary.
Right, just
and she pretty successfully did.
Don't screw it up, and she basically didn't. Powell, faced with, the first real inflationary challenge in 40 years, failed during 22, but other than 2022, I thought Powell was excellent. I think he handled 2000 very well. I think he handled the last 3 years very well. We'll see where Warsh ends up landing when it's all said and done. Quick break here. When we come back, we got the trivia answer, we got Wall Street Watch, and should you really feel so bad about the economy?
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative Stephen Lynch are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Markets are in rally mode, extending their gains by midday on the heels of impressive earnings from Cisco. Investors are also keeping a close eye on developments from the summit between President Trump and Chinese President Xi Jinping. Right now, the Dow up 0.8%, S&P 500 up nearly 0.9%, NASDAQ now up 1% or 263 points. Russell 2000 is up 0.75%, 10-year Treasury yield down 2 basis points at 4.451%, and oil pulling back slightly, trading right around $100 a barrel. Cisco rallying 15% after the tech firm announced it will cut fewer than 4,000 jobs this quarter, or about 5% of its workforce, so it can allocate more resources into high-growth areas like AI infrastructure. Meanwhile, Versant Media Group saw its revenue and profit fall in the second quarter since being spun off from Comcast, but they were better than expected. The company also reported revenue growth across its content licensing and digital platforms. That stock up over 3%. Elsewhere, Biogen down over 4%, despite the biopharmaceutical company announcing its experimental Alzheimer's drug will advance into a phase 3 trial. Outdoor products company Yeti impressed with its quarterly results, sending shares up by 6%. And ticket seller StubHub also beat expectations, sending shares surging by 19%. Semiconductor equipment maker Applied Materials will report after today's closing bell. I'm Tucker Silva, and that is Wall Street Watch. In the previous segment, we asked you the trivia question: how many amendments are in the Constitution? That would be 27. And Bill from Waltham, Mass. is our trivia winner today, taking home a Financial Exchange Show t-shirt. Congrats to Bill. And we play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
The University of Michigan consumer sentiment data came out last week. We covered it. The index came in at a reading of 48.2, which is the worst it has ever been. Which, you get this piece from CNBC being like, Americans still feel bad about the economy. When will it get better?
Never.
And here's the thing. Two things are true, and again, you got to hold these two views in your head simultaneously. Number one, the economy is not the worst that it's ever been.
Very obviously.
Like, I got to be honest. I don't know who's filling out these surveys now.
Don't you think you run into people, though, that are that dramatic every once in a while?
Yes,
I do.
Yes.
The economy is worse than it's ever been.
So this is what
I
I
hear
think.
that from people sometimes.
This is what I think.
And I ask them if they even remember 15 years ago.
This is what I think, is that in the social media age, we just, the way that you actually, your brain ends up being rewired is to post the most dramatic stuff you can, because that gets the most engagement and that triggers your dopamine response. Then you're like, ooh, I gotta keep posting like that. That's getting the likes. And so you just say all these outrageous things like the moon is made of green cheese and I'll never, like lawns again because of the worms, and like just all kinds of weird stuff that you end up falling into.
Man, your social media feed is really different.
Well, I don't go on social media. I haven't been on my Facebook account in 6 years. So to all of you listening who tried to friend request me, sorry, I can't get into it anymore.
No, nobody did.
I know that's. To be fair, I do ask my wife once a year. I'm like, hey, do you see anything weird on my Facebook? She's like, no, why? I'm like, because I don't know how to get back in, and I haven't been on it since August of 21, and I just want to make sure nothing weird's going on.
Yeah, that's fair.
So I check in with her once a year on it. But I just think social media has so warped our brains that surveys like this are broken, because I can tell you this. If you took 100 Americans from right now and put them into the U.S. economy in June of 2010,
oh man,
within 5 minutes they'd be like, take me back.
They would just curl up and start crying.
Likewise, if you took them from right now and put them into August of 1973, they'd be like, nope, where's the undo button? Not going to do it. So
I heard it put very well by a history author who was having somebody describe the world to him as really tragic right now. And his response was, during the Great Depression, they shut down the zoos, killed the animals, and distributed the meat. So you're going to have a tough time convincing me that the economy right now is that bad.
Part of me so you couple that with the fact that, hey, the economy is tough for a lot of people right now.
Yep.
It's been tough for the last 5 or 6 years. There's been, again, since 2020, I've gone through this. Every year, it's just been one thing after another, just a bludgeoning. It's like, okay, first you got COVID, then you got, the supply shocks in 21, you got inflation in 22, the banks are failing in 23, the job market's slowing in 24, AI is going to eat our lunch in 25. Oh no, tariffs in 25.
Yeah.
26 is war in the Middle East and gas prices going up. Like it's been something every year. So I get it. Like we can feel exhausted, but we can feel economically exhausted without saying this is the worst economy ever.
Yeah. I'll tell you, with the news moving as quickly as it does, in spite of the fact that, many portfolios are reaching high watermarks that they've never seen before, I do completely comprehend how it would be nerve-wracking to make a decision, a big financial life decision right now. like retirement.
Buying a house, retiring.
And you see some of that in the data. Home purchases are not moving year over year. Retirements, based on the labor force participation rate, might still be happening. But I can completely comprehend how this moment in time might lead to some choice paralysis, especially when it comes to retirement, folks. I was speaking with somebody in their late 50s about this just yesterday. You may go through the exercise and determine that you still have to work another 4 or 5 years. You might go through an exercise of planning out your retirement and discover that, hey, I could pretty comfortably pull this off today. But having the answer in your back pocket makes just going to work that much more tolerable and pleasant. Like, hey, yep, I know I've got a number in the back of my mind that I need to reach before I can pull the trigger, or I know I need to make it through this many more days of work before my financial plan is going to work. I think what is really difficult is being in your late 50s, early 60s, going to work every day and not having any certainty that you'll ever be able to stop. And I know there are people that are in that position, and I cannot tell you how many times we have had surprising conversations with folks that, hey, you might be able to pull this off a lot earlier than you realize, and here's the path to do that. If you want to try and answer that question, you might need some help, and if you'd like help from the Armstrong Advisory Group, we're here to do so. The number's 800-393-4001. Don't work longer than you have to unless you really want to. Again, 800-393-4001, or you can check us out online, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Let's take a quick break. When we come back, we'll do a little bit of stack roulette.
From markets to money to business and financial news, watch the Financial Exchange every day on YouTube. Hit that subscribe button and keep up to date on the market news you need to know. This is the Financial Exchange. Text us at 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we are covering. This is the Financial Exchange Radio Network.
Mike, what do you got for stack roulette?
I want to talk about restaurants that are needing to adapt their menus and struggling a little bit in the days of GLP-1 users. There's an estimated, I believe, 10 million Americans, about 12% of the adult population, who have taken GLP-1 drugs.
Doesn't that seem
as of
light?
last fall.
Pun intended.
12% of Americans.
Seems high, I thought.
Oh, I thought it seems low.
What portion of Americans are obese?
I don't know. Maybe,
It's more than 12%.
maybe it's just like my age demo and the people that I run into, but
Probably,
I feel like I feel like at least in that age 30 to 50 suburban demo, it feels like it's close to like 25 or 30%.
Remember, you have to be pretty wealthy to be on these things.
Do you now? I thought there were all kinds of subsidies that came in the
Yes, and I mean it's still.
I don't know the cost,
drug.
But anyways, I digress.
In any case, restaurants are adapting their menus. They're focusing. Well, everyone and their mother is focusing on higher protein items, smaller portions, and I don't know if they're going to be successful or not. What I will say is, if the cost of lowering the rates of obesity and heart disease is a few restaurants having smaller profits, like, sign me up, all on board. I will deal with that societal trade-off. But in the meantime, you are seeing even restaurants like the Cheesecake Factory completely reshaping their menu with entire sections devoted to GLP-1 users who just ain't as hungry as they used to be.
Page 79 of their menu.
Yeah, you do have to scroll through the index of that thing for a while to find the right page, but you will eventually get there at the Cheesecake Factory for that lower calorie menu.
I'm not buying this.
You don't think it's
Nope.
going to be the case?
Well, no, I am buying that restaurants are trying to shrink portions.
You think
I
it's
think
just
they're
inflation?
trying to do it because of inflation, and it's the only way they can keep their costs in line.
Maybe the thing is, like, most restaurants that I've seen are not completely redoing their menu. They're just adding new sections of lower.
Which, like, what restaurants
Skinnier
are doing
stuff.
this? Like, I know you mentioned Cheesecake Factory. I got to be honest. I've been to a lot of restaurants lately for various reasons. I haven't seen a GLP-1 section on any.
I've seen a few of them, and it's mainly chain restaurants, but I know that it was either, no, it wasn't Bertucci's. It was Olive Garden has one, Cheesecake Factory has one. So it's the big guys that are moving around first, I think. And yeah, we'll see if it's a bunch of nonsense. I know people have been talking about, like, every time that a food company reported bad earnings anytime over the last 2 years, they've blamed it on weight loss drugs. And so I'm with you there. I'm not sure that there's actually a there.
I'm trying to, I'm just pulling up the Olive Garden menu just because, again, those of you who have listened to the show know that you can like Olive Garden for what it is, which is a great meeting place for, like, people of all kinds to, like, come together. Mm-hmm. But I firmly believe it's not Italian food. Having said that,
it's American. I mean, yeah.
I don't know.
It's Italian food in the same way that Panda Express is Chinese food.
Exactly. So I think in looking at this, so you're talking about, like, this lighter portions menu?
Yeah.
So here's the deal. I'm looking at it right now. And I've got the Lasagna Classico, a 500 cal version for $15.49. Mm-hmm. If I were to, let's see, where's the regular lasagna? Oh, come on. Family style lasagna bundle? No, that's 6,700 calories. That's not the comp. Here we go.
Take one.
Here's the regular one. Here's why I think that you're being scammed by this menu.
Okay.
Scammed might be a strong word, but here's why I think that you're being hosed by this menu. Because, like, you are getting what you paid for, it's just you're paying too much. The regular Lasagna Classico at Olive Garden, $19.99 for 940 calories. The one on the lighter portions menu, $15.99 for 500. Michael, if one really wanted to eat a smaller portion, you are better off buying the Lasagna Classico, splitting it in half, and having the other half for lunch tomorrow.
You are, yeah.
This is why they are trying. If they really were trying to make it such that it was just, oh, we want to offer smaller portions for you, it wouldn't be 75% of the cost for 50% of the calories.
Chuck, I never said that any of this was designed to be good for the consumer. I just said that they are trying to appeal to a customer that is looking for lower calorie options, and they think they can make money on it too.
And I am saying, Tucker, put this on the prediction board.
Okay.
For 2030, which is not as far off as we think, the Lasagna Classico at Olive Garden will be one size only, and it will be the 500 cal version for the 900 cal price.
I'll tell you, I think that, Chuck, you are vastly overestimating Americans' math skills.
I'm correctly estimating them, because what's going to happen is the small is going to become the norm. And they're going to think no one can pick up on it.
Yeah, got it.
That's what they're going to get rid of the big one, and then you're just going to get left with the small one.
Could be.
Now, could we all stand to drop a pound or two, especially after the holidays?
Maybe I shouldn't be having 1,000 calorie piece of lasagna every night for dinner. I don't know.
Or maybe I should get the family one at 6,700 calories and see if I can finish it in a single serving, because that sounds like a nice day to me.
Yeah.
Piece in the Wall Street Journal. A grades are now suddenly everywhere since the arrival of ChatGPT.
Good.
So, I saw this piece and was like, okay, show me what you actually have here. And here's the crux of it. And I quote, "The share of A's in college classes heavy on writing and coding, in other words, work more prone to AI use, has grown more significantly than in other classes since ChatGPT's debut, according to a paper from the University of California, Berkeley, released on Wednesday. Professors teaching AI-exposed classes gave out 30% more A's and fewer A- and B+ grades. The results suggest that students have relied on generative AI to do better in their studies, not that these classes of students are learning more." So this gets to the age-old question of hey, do you need to be able to do your math test without the calculator, or can you use the calculator to do it? And in the case of computer science, quite honestly, I think that if you are not grading your students on the use of AI for coding, you're doing them a disservice, because that's how it's going to be done in the future.
Right. Yeah.
You want AI to be used in those courses for the coding work, because that's how they're doing it at the big companies now.
Right. You could hypothetically have your exam be in person and block all of the AI systems from being able to be used during the exam. But what would be the point? These people are only being hired because they have the AI skills to do the coding.
Correct.
On the writing stuff,
I buy, because here's the thing. Well, actually, no. I buy it, but I don't. Here are my two problems. Number one, if you actually read a lot of AI-related reasoning, it's hot garbage and repetitive. And if I were a professor and I saw some of the telltale signs of AI writing in a piece, I would know that you're writing it using AI, and I'd be like, get out of here.
So what part don't you buy? I mean, the grade inflation is pretty clearly happening from this study. So which part don't you buy? That
I think that any professor of history or English should be able to pretty easily identify an AI written piece and grade it appropriately.
Yeah.
And I think if you want to allow AI assisted writing in those courses, that's fine, and you can grade that as you see fit. But from a personal perspective, as someone who believes that writing and developing an argument are critical skills of thought that you need to teach, I would basically I'd go old school on it. Here's your blue book, sit down at the desk, and write your essay without any help.
Or argue your point in person to me. I feel like that skill is so undervalued.
Do one of your two things.
Talk to me in person.
Well, this is the other thing. My favorite course in college was our financial markets course, which led me here, I guess. The 2/3 of your grade was all Socratic method from just the prof asking questions during the course of the time. Your actual tests were a really small portion, and the homework was not a big piece. It was, no, I'm going to grade you on talking about this stuff in class because that's going to prove to me that you know it. So, I don't know, maybe we can do more of that. That sounds fun and nice and wicked smart, too. We're going to take a quick break for the rest of the day, but tomorrow we're back, and there's no exciting economic data, so don't tune in for that, but tune in just because you want to hang out with us for a couple hours, and we want to hang out with you too. We'll see you then.
Hi, this is Chuck